Provident Healthcare Partners is a healthcare investment bank that is focused on transaction advisory services. We created this podcast for healthcare executives, entrepreneurs, shareholders, and providers who are interested in learning more about the world of healthcare consolidation.
Hello and welcome to the latest podcast from Provident Healthcare Partners. My name is Scott Davis and I'm joined by Kevin Palamara and Eric Major for today's discussion. Today's topic will be to cover 2018, our wrap up on productivity within the healthcare services M&A market, and our outlook on 2019. With this being the first discussion following the annual JP Morgan Healthcare Conference, which along the same lines is an outlook on the 2019 deal space, we'd like to get a little bit of commentary from the team in terms of what the messages were from the consolidators at the conference and more generally what the conference is intended to cover. So Kevin, why don't you start us off with an overview of the JP Morgan conference?
Thanks, Scott. So each January out in San Francisco, there is really the largest gathering of healthcare professionals and private equity organizations and investment banking organizations over the course of 3 days to gather and have several panels, meetings, et cetera, to really cover and reflect upon 2018 and to discuss the merger and acquisition market for 2019 within the areas of healthcare services. From the Provident Healthcare perspective, the most important thing for us when we attend these conferences is to spend time over the course of those 3 days with our private equity partners within the healthcare community. We typically split up meetings amongst 3 or 4 individuals and spend the entirety of the day meeting with those folks for about an hour at a time, talking about their interest in the healthcare space, talking about areas in which they might have a specific thesis, including existing portfolio companies and areas where they may be looking for platforms. It really helps us as we get into 2019 kind of develop our own internal thesis around which areas we want to remain focused on or new areas that we want to focus on over the course of the year. And to some extent, some of those meetings we do meet with strategic consolidators, but from our perspective, it tends to be more important to spend time with those folks within the private equity community, which is ever evolving to kind of understand where there are areas that maybe we have overlap on as we consider our pipeline for 2019. Scott, I know you were one of our attendees at this year's conference. Maybe you could give a little color on those specific areas that groups seem to be more laser focused on as we head into 2019.
Yeah, absolutely. So keeping in mind the fact that this was second week of January 2019, we were, as a broader market, going through some volatility. So I think people came in a little unsure as to what 2019 may hold, and that has definitely an effect on some of their investment theses, in particular around the outlook on the ability to obtain debt for these leveraged buyouts. And so I think we came into the conference with people a little bit scattered in their thoughts. In prior years, they were a little bit more thematic in their approach. It seemed as though the meetings had a similar tenor and similar focus between private equity groups across the healthcare services landscape. This year, again, it was a little bit more scattered. I think that you heard a little bit more excitement about the under-consolidated spaces and those that have not seen as much transaction as some of these spaces we've seen in the past, particularly on the physician services side. So again, some new outlook on physician services, while also an increased excitement around some of the outsourced services to the healthcare industry. So for example, pharmaceutical services space and cost-saving measures, contract-based businesses, things of that nature that I think we definitely saw a market increase in excitement around. And so sticking with the theme of market volatility in 2018, Eric, what did you see, if any, effect did that have on Provident's transaction work, but also more broadly in the market?
Yeah, I would say, broadly speaking, obviously we saw a lot of volatility in the public markets in 2018, especially in the latter half of the year. I think the impact has been fairly minimal in the lower middle market where Provident operates and, where a number of the investors that we met with at the conference operate in. Certainly the bigger concern and impact is around interest rates. I think, we saw several interest rate hikes in 2018. We expect to see additional hikes in 2019, although the Fed seems to be open to keeping them relatively stable unless they see something dramatically impact the market that would cause them to raise the rates again in 2019. The impact, I think, on Provident's pipeline and our 2018 deals was very minimal. We do expect that private equity firms are going to be a little bit more sensitive to interest rate increases in 2019, and perhaps we start to see a small impact on valuations. But in terms of our 2018 performance, we closed 10 deals across 8 different sectors in healthcare services. Valuations were very strong for the year, and even our most recent letters of intent that we've signed as well, we haven't seen a dramatic change in the market in terms of pricing or interest level from investors.
Yeah, and I think when you consider the JPM conference, one of the areas I don't think we really touched upon that we had several meetings with were those groups that provide debt to the private equity community, and we had several meetings with those groups, and I do think that will be one area where, with the markets being a bit more volatile, heading into 2019, we are starting to see groups spend a bit more time up front talking with those lending groups, looking into what kind of leverage they can obtain on our transactions. But again, I think to Eric's point, we haven't really seen that impact valuations on our current transactions, and we're staying in touch as well with those debt providers, and their leverage seems to be pretty consistent with where they were at in the early part of 2018, which is obviously a good sign for folks out in the market.
So Eric, you mentioned the 10 completed transactions for Provident in 2018. Can you give us a little bit of color in terms of what subsectors those focused on and any change from the historical business line?
Yeah, I would say following the themes that we heard at JP Morgan, I think we're focused on a lot of the areas that investors are looking at. So that include deals that we've closed in ophthalmology in 2018, 2 transactions in that sector. That's been an area where investors have been very interested in for the last 5 years or so. And there's over 20 different private equity firms that have closed transactions in that space. Also continued activity within the dermatology sector as we closed a deal in that space in the New York market with a private equity firm. And then even on the areas outside of physician services, I think the outsource theme is reflective in our transaction that we closed in the ambulance sector, as hospitals are increasingly outsourcing services, whether it's provider services or also ambulance and other ancillary services to the hospital as well. Kevin, you want to touch on some of the other non-physician areas?
Yeah, so in 2018, we, again, as Eric mentioned, we spent a lot of our time still focused on the physician practice marketplace with those outpatient service providers. But there were a few transactions in which we were kind of focused on deals that were outside the physician market. One of those transactions was the completion of the sale of People's Health down in Louisiana, a transaction that we concluded in the middle of 2018 with United Health Group. They were the largest provider, the largest independent provider of Medicare Advantage services in the state of Louisiana, and represented an attractive entry point for United Health to get into the state in a big way. So again, that's one of the rare kind of strategic transactions we completed in 2018. And kind of looking back to JPM and the fact that we talked to a lot of private equity groups, you tend to find that most of our transactions are with those private equity groups. But in that case, we completed that deal with United Health Group. The other transaction, which was kind of a sector we haven't been very active in probably the last really 5 or 10 years, which we do think is starting to see a little bit of a comeback, is in the area of durable medical equipment. We represented a company called Medical West out in the Midwest market in their sale to Lincare. Lincare is probably the number 1 or number 2 in terms of market share provider of home medical equipment and related services direct to the patient in the United States. Again, I think that's one of those areas outside of the physician market where we could see some additional activity as we move into 2019 with the reimbursement market there and the regulatory environment kind of stabilizing, which was really one of the factors that led to reduced activity in that marketplace over the past really 5 or 10 years.
Yeah, and I guess Scott and Kevin, when you were at the conference looking at our pipeline for 2019, what areas were groups most excited about in terms of new platforms or potentially existing areas that have seen increasing strategic activity as well?
Yeah, I think I can start from a physician service standpoint. I think we saw the continued interest that Eric outlined around the historical spaces, and going forward, some new kind of outsourced multi-site physician service models that are actually starting to heat up, and we're actually starting to see quite a bit in our own pipeline. Areas such as gastroenterology, urology, orthopedics, all of which have several platforms established. Beyond that, oral surgery seems to be a new space of excitement in the surgical arena. Women's health, although there's 4 transactions currently completed and private equity backed, continues to be an area of excitement. Podiatry saw its first transaction completed through a private equity investment. And then ENT and allergy, again, with just a couple transactions completed, but continued interest from the private equity space. I would say all of those areas are ones that we're going to see continued consolidation in 2019 and beyond, with some of the same tailwinds that we've seen historically in terms of under-consolidated markets, highly fragmented, and the opportunity for ancillary services and professionalization of these outsourced physician units. So I would say that's the interest level on the physician side. Kevin, on the outsourced services?
Yeah, I think on the outsourced services side and really on the non-physician side of things, I think the area that's probably the most exciting to us as we move into 2019 is really the post-acute care space or the home care space. That's a sector that has many different service offerings, many different areas of consolidation opportunities, and we're very active in that space right now with deals under letter of intent, deals actively in the marketplace. And, I think there's tremendous opportunity there because you could look at groups that focus on Medicare patient. You could look at groups that look at different Medicaid models, private pay models, hospice care models. And there's actually some very unique disruptive models out there as well with these groups that are kind of focused on providing direct care through family members in certain states where programs will allow. And I think we've seen some pretty significant large-scale transactions in that space with groups like Humana making a significant move in acquiring a majority stake in Kindred, becoming really the largest provider of post-acute care services in the country through that transaction. Groups like Amedisys on the public markets making a very large transaction towards the end of 2018 with a very large hospice acquisition. So I do think that's an area where we're going to be focused on pretty significantly here at Provident, and I do think there'll be a ton of private equity activity in those marketplaces. I think specifically one area where we probably haven't seen as much private equity consolidation is the Medicare home care arena. I do think that will pick up as we move into 2019. I think we will see some new platforms developed in that specific marketplace, along with some other kind of unique and disruptive models that we're engaged with at the current moment. So Scott, kind of going back to the JPM conference and thinking forward to 2019, I think one of the themes you heard specifically at those meetings with private equity groups was some of the challenges they've seen in trying to develop a platform in certain sectors of healthcare and some of the unique structures that they're trying to deploy in order to be effective at the outset with these platforms in physician services or non-physician services. Maybe you could speak a little to what you heard at the conference.
Yeah, absolutely. I definitely think groups are having to become a little bit more creative to get transactions done in today's environment. I think, first and foremost, that stems from just the overall increased level of competition to get deals done. You're seeing larger funds come downstream to look at smaller assets time and time again, as a result of simply trying to find a platform asset in healthcare services as that sector has heated up the past 10 plus years or so. As a result of an increased focus on physician services, many times those businesses are relatively unprofessionalized. They're owned and operated by physicians who spend all of their day seeing patients, rightfully so, and therefore some of the back office functions have been a little bit overlooked as opposed to other business models. So as a result of that, what the value that a lot of these investor groups bring to the table is the ability to focus on those things and bring people in that have experience running businesses of larger scale and what can that bring to the table for what is a business looking to take that next step. So one way we see that being deployed by private equity groups is using the operating partner model. So utilizing individuals that have served either in an operations capacity or at the very least a board level capacity for larger businesses through successful private equity exits on a historic basis. So they'll utilize them for these smaller assets they're investing in today, again, with the eye toward growing that business to a larger scale and seeing that similar exit. Outside of the operating partner model, we're also seeing groups deploy a model whereby they take several smaller groups and cobble them together for what is to be their platform investment. Again, this can bring risks in terms of just through getting through the due diligence process and the complications that come with dealing with different shareholder groups and different business dynamics and getting those deals to the finish line. Outside of that, we're even seeing groups start from ground zero, so utilizing an operating partner model and starting a business from scratch. They are having trouble finding that right asset in a subsector they've been focusing on for maybe a year or 2 years and have finally said to themselves, we have the operator, let's go out there and start a business of our own in a market that we've identified as being a frothy one. And some of the subsectors we've actually seen that deployed in through the conversations with these investors is areas such as the autism services space or veterinary services. Both of those arenas have seen increased appetite from investors with valuations going extremely high, but a lack of deal flow in order to meet that demand. And so what else are you guys seeing in terms of creative structures out of investor groups?
Thanks, Scott. So one of the areas where structure is really starting to come into play more and more with our transactions, and I think this will continue in 2019, is really an area where our clients are starting to give us initiatives where they're looking for us to look at transaction structures that provide them more equity in the business moving forward and in kind of minority structured deals. And I think as we went to JP Morgan and sat down with private equity groups, I think that they're starting to hear that same message. I think that we're starting to see private equity groups have more flexibility when it comes to investing as a minority partner as opposed to groups that typically want to or need to have control as part of their investing strategy. I think that's something we're going to see moving forward because we do have a lot of these healthcare groups we work with that have young shareholders at the table, young physician groups, and they're not at a point in their career where they're ready to give up 70, 80, 90% of the equity in their business. So I think that's definitely one of the unique structures that we're going to start to see become more prevalent as we move into 2019. I also think that, even going beyond that, we're starting to see groups come to us in terms of healthcare clients asking if there's alternatives to private equity, and is there an alternative to do more of a dividend recap where I'm not giving up any equity in my business today, and I'm taking some chips off the table, but maintaining 100% control, of the equity interest. So again, just kind of going back to our earlier discussion, there were several groups we met with over the course of JPM where we started to have those discussions and kind of see what that market looks like. So I do think we'll have a few initiatives as we go into 2019 with these healthcare groups that maybe aren't ready to go through the private equity process and give up equity, but may want to do a significant dividend recap, again, for purposes of providing themselves or their families with some liquidity, but again, maintaining that control in the entity for some time moving forward.
Thanks, Kevin. And Eric, as we think about 2019, what do you think for predictions for the coming year?
Yeah, I think we talked about earlier some of the risks going into 2019, with one of them being kind of interest rates. I think the big positive we see is that the amount of capital overhang, which is really the undeployed capital that investors have raised over the last several years, continues to be very high, and I think that's continuing to put pressure on investors to put money to work, which is why we don't see a major change happening to valuations in 2019. I think one of the areas we need to be more cognizant of as an investment bank is just increased scrutiny from investors in due diligence. We've been seeing that, especially in the latter half of 2018 into early part of 2019, groups trying to use due diligence as ways to kind of chip away at purchase price, or with valuations continuing into their third year, maybe even fourth year of being near all-time highs. I think we're expecting that investors will continue to heavily scrutinize deals and due diligence and continue to bring in a number of third parties to make sure that things like reimbursement or contracts and real estate, for example, all these different areas of the business, billing and coding, are up to par. We expect that they'll continue to be heavily scrutinizing deals as a result of all this competition. To win transactions, groups have been paying substantial multiples, and they want to make sure that the investment that they're making is sound and they feel like they can scale the business. I mean, Kevin, from your perspective, where do you think, as bankers, we can continue to drive value for our clients and make sure these deals close at the price that we've signed in the LOI?
You're absolutely right, Eric. I mean, the good thing is the valuations remain at pretty much all-time highs. They've been pretty steady the past 2 or 3 years. Along with that, though, you are seeing a lot more scrutiny with the private equity groups and a somewhat more challenging due diligence process. So I think to combat that is we have these really competitive processes where we have multiple groups kind of coming in at these attractive valuations. I think one of the approaches we can take as a firm, and will be taking as a firm, is to really take more than one group forward into exclusivity and create a process in which you have 2 or 3 groups, maybe even more, participating in a full due diligence process under a letter of intent. And I think that allows us to keep that competition at the table really all the way up until closing, keeps those groups honest, and really ensures our clients that at the end of the day, we'll find you a good partner, we'll keep the valuation at the level that was agreed to at the letter of intent. And I think that's something I think that we can employ just based on the fact that the market remains extremely competitive. You have these private equity groups that are typically coming in at very similar valuation levels, very attractive valuation levels. And instead of just kind of moving forward with one, you kind of put the onus on those groups to put some money on the table and spend some money in due diligence. I think from our clients' perspective, there's also some things we can do to combat the challenges that may come up in, really the process and due diligence, especially with the fact that we are very focused on the physician market. And I think what we would tell our clients, especially within the physician world, is I think there needs to be a lot of transparency and education with their shareholder group, and with, as we've seen on some recent transactions, education to those associates that might be on a partnership track, because those are really the things on our side, kind of on the sell side of the deal, that can really create hurdles as you get further into the process. And I think the more transparent and the more education you can provide to your physician shareholders, specifically in that sector, I think the better off you are, and the higher the chances are of you getting a transaction closed, at those attractive valuations.
Great. Well, Kevin, Eric, thanks for your insight into 2019 and beyond. Hopefully our listeners enjoyed the conversation, and thank you for tuning in.